Do it. All right, it should be live, but there's a bit of a delay, right? Like a minute or two. So try to refresh your page because it's up and going now. All right. So yeah, take that approach, right? That'll get it done. So the Z score is a really helpful tool for that. Now I asked ChatGPT to give me some, well, actually it was Grok, but whatever. I asked AI to give me some limitations, right? Because I know the good stuff, but I don't think of it this way. So I needed some input. I asked AI, hey, when it comes to the Z score, what are some of the limitations on it? And it said that it assumes price follows a normal distribution, but financial markets often exhibit fat tails, which are extreme moves, which are more common than normal distribution predicts. All right. So, what it's saying is that markets are not just calm, rational markets that move consistently to its average daily range every day. They make outsized moves all the time that still doesn't exceed their Z score. So, you know, that's a limitation that it is assuming normality when price is often not normal to begin with. The second thing it said is it's a lagging indicator. Now, I knew that, and I'm pretty sure you all knew that, but it's still worth saying because somebody's new and maybe doesn't know that. It's looking back at old price action, asking what the standard deviation is, and then it's looking at the move that just happened, which is also a look back, asking if this new move had exceeded the previous price action's one standard deviation move. All of that is a look back function, right? So it's worth saying because that's one I always forget to mention. It is a lagging indicator and that context matters, that a high Z score by itself does not promise or guarantee a reversal or a continuation. It has to be combined with other things, whether that's price or some other indicator or support and resistance, some kind of technical analysis on the candles, something that we don't want to just use the indicator in isolation by itself. So those are nice contributions from the AI that assisted with this. Absolutely. I have found that indicators are fantastic for scanners. I don't trade with indicators, so to me, I've never had a problem with the whole lagging issue. And I forget to say that indicators are lagging because, well, I just don't trade with them. But from a scanner point of view, indicators are awesome. They're fantastic for that. So the internet issues and the sound problems and everything, we're going to go through the Z score real quick again. If you already heard it, just go grab some cookies and milk, get a snack. We'll be done quick enough. The Z score is a measurement on price action over a standard distribution. So it fits in the conversation with a lot of the things we've talked about lately with Bollinger Bands, VWAP bands, price when we're talking about high probability trades and options. We use one standard deviation in expected move. So, statistical mathematics, the bell curve, that's what we're focused on. Price has a distribution curve, and we want to see when it makes moves that are too far, too fast. And that's where this really shines. It's helping you identify one, have we moved too far, too fast? And if we have, does it owe us any sort of mean reversion or pullback to the mean? And so that's how you can use it. Now you can use it on any time frame. I'm showing it on the daily and the weekly because that's usually when I uh, run this when I'm looking for things. Have we moved too far? That's usually a weekly and a daily thing for me. But you can do it on the intraday too, because anything that moves has something that we can track, and then we can ask that question. Earlier, I gave the example of Apple here when it wasn't earnings. So it was earnings moves are always expected. It doesn't catch people by surprise. So when I find examples that I like to use, I try not to use earnings examples. Apple had this big gap down off the 200, and then it gapped again, and then again, and then again before it finally ripped and ran back up and tried to recover from that gap. And the Z score showed that it got out of line on the biggest day on April 4. Well, if you look, that was this day here. The big gap day, the very first one, barely registered as a two standard deviation move. The next one after that was the biggest one, and then it started to get smaller again. That one green day, the recovery bar, ended all of that oversold condition. And so, even though we were a long ways off from where the whole move started, we were no longer in an oversold environment by the end of that day, right there. And the Z score told us that. So that if we were late to the game and we had this big move happen and then this day closed and we're wondering, is this thing still oversold? Could I try to get more to the downside? The Z score was saying, nope, we've already resolved that. We were all the way back up here at this point. That it was no longer overbought or oversold, and that we were basically back to the mean again already. So you can use this to validate whether or not a stock is overbought or oversold, and you can use it to confirm that it no longer is overbought or oversold. It is important to recognize, however, that even though something may not be overbought or oversold, that it doesn't have to, that doesn't mean that it can't mean revert, right? Now, um, there are different kinds of Z score indicators. This one resets every day with a new bar, meaning the mean begins at the open, which is a little different than, say, the one on TradingView over here. This one is a running total. And if we put it out here on the daily, that Z score is different, right? Because it is continuing to run on the math of the previous day. So that if we go and look at, for an example, Apple, let's try to find that April move here with the big gap down. Well, that thing just colored my candles and everything. What a ornery thing to do. But whatever. There's that big gap down and the run back up. And here's the Z score. They made this indicator so fancy, and yet they couldn't even put a zero line in there. Come on, man. Just, give it a little bit of thought before you publish something. Anyway, there's the drop, right? We can see, let's just zoom in here. The big day happened, and during that whole run, the Z score widened and got bigger and bigger and bigger. And then same thing, we had that big up bar and it resolved over half of the oversold condition almost in one day. Yeah, I mean, that's the play, right? But if you're going to try this with options, look at how fast these issues get resolved, right? So, one, you want to check after a big move happens and you're thinking, oh, that was a big move. I'm going to go the other direction. It can resolve itself really fast, 1 or 2 days, and it can be resolved. And when we're talking about, quote, back the other way, it doesn't necessarily mean that it's going to go back to where it started. It's just going to go back the other way to a point where it's no longer overbought or oversold. It's just going to go back the other way some, right? Now, the thing about credit spreads is, and that's the perfect one to use in this scenario. If we did it on Apple, if we put a credit spread on down there, what the spread says is, hey, I bet you don't go any lower. Perfect. That's exactly the way to play this. Because if you bought a call or if you put on a call debit spread, then you'd be trying to trade, well, how far up are we actually going to go? And the Z score, it doesn't say we're going to go up at all. It really just says we're probably done falling. A credit spread fits that scenario really well. We're done falling, put on a credit spread. Perfect. Plus, this move to the downside generated a lot of volatility, which increased the cost of the options. And then you sold those options, which means you get more credit for selling them. And they should decay faster as price rises away from you. So, time decay makes them profitable. The price moving away from you makes them profitable. And if price really doesn't run far away, but it just stops falling, volatility will crush those options and that'll make it more profitable faster, right? Because you're only going to get the credit that you got. It's not like you're going to get more credit. But yeah, credit spread would be a good way to play it. And it's interesting to note, that we can get big moves and we would begin to assume that we've made a 2 or 3 standard deviation move, and then you turn on the z-score and you're like, shoot, we didn't even hit 2. I guess it wasn't as big of a move as I thought it was. And it can help you grasp that logic. Like right here, we had some big moves in Apple in this window of time right here. Those looked big, and if we were looking at that like, oh wow, that was some big moves in 3 days, the z-score said nope, wasn't a big move at all, and that it did not owe us any sort of mean reversion. So those are some good examples of, using this thing to validate the price action and our assumption of too far, too fast. You could tie this in with Linreg channels. Like I think it was Jeremy or Marziti that was doing Linreg channels, maybe both. Yeah, it's funny you mentioned that. I have recently been moving my moving averages to a high-low close or an open high-low close average rather than using the close. So, like on Thinkorswim here, my 200 period exponential moving average, which is on my intraday chart with VWAP, is using open high-low close divided by 4, right? It's the average of price rather than the close of price. Because with moving averages, we can do basically whatever we want, and I've been running them on an average. So it's interesting you say you brought that up. These have been really great days for me recently. Just it is a example of my price over and over and over and over again, and I really like that. And then on the days that it's not, it's so obviously not that there's not even anything for me to mess with. I'm not sitting there saying, "I wonder if I'm going to get a trade today," because I know I'm not going to get a trade. I don't even bother with it. I just leave it alone, do something else, or trade a different market. You know, I guess that's the best you can hope for is to have the kind of trading day where it is obviously your day or it is obviously not your day, and you just leave it alone and do something else. You can make a Discord. If you look in the lower left part of the Discord, there's a plus sign, add a server. They're free, it doesn't cost you anything. And once you make the Discord, you can put bots in it, but that can be a little confusing or overwhelming for new people new to Discord. There's a lot of videos out there that'll show you how to kind of get this put together. Then start making channels. And if you make one for your playbook, for an example, which is what I call this one, my OAC playbook, you can go in and put your trade strategies in there, right? You can take the time to articulate what your trade is because you should be able to describe it, right? If it's your trade, you should be able to put it into words. And if you do that, you may find that you're understanding your trade better because you did put it into words. There's the moving average bounce trade, for an example, using something like a 15-minute chart and a 50 period simple moving average. There's the cross up play, the cross down play, walk the dog upside, walk the dog downside, have the risk to reward part of it, the profit side, options, how many contracts can use, minimum stop size, scaling in factors, right? All the rules for the moving average bounce trade or using the on balance volume swing stack strategy, right? Like it's your playbook. You can put whatever you want in there. To me, I like having the playbook and the journal in the same spot so that I can journal trades and I can link them back to specific strategies that I've put together. Small account growth rules, just anything that you want to put in there, right? There's no wrong way to go. And then as you trade that strategy, you have a place to write down things that you're realizing about it. Like maybe it doesn't work on short weeks, or maybe the strategy isn't good on stocks that are going to do dividend this month, right? Like there's little nuanced things that you learn about a strategy as you work that strategy that maybe aren't in the books, right? Especially if you make your strategy from scratch, then there's no book to learn from to begin with. And those notes can help you dial in the things that you are noticing and experiencing, and then it's a learning game. I hate losing. But if I can tie my loss to something and I get something out of it, like I learn a really good lesson and I find a way to do things better, then the loss paid for itself because it I got something out of it. If you don't journal your trades, then those losses aren't giving you anything. I was really hoping when I popped on this one that it would have my calculator in there. Dang it. Still don't have it. Let's see. I'm going to run a search. Um, what is the express XLSX? XLSX. Collected credit calculator. Yeah. Yeah, yeah, yeah. Maybe. All right. I think this is the one. Credit spread assumptions. We make assumptions about credit spreads, and one of those assumptions are that if we close it early, we increase our win rate. Technical analysis can increase our win rate. Working with IVR accelerates our P&L. Trade has delta percent chance of losing. Losses are always going to be 100%. If you work with these assumptions, things will go better. It's Nobody's saying you have to take 100% loss, right? I'm certainly not telling you to take 100% loss, but if you assume it's going to be 100% loss, it will help you run the math on the numbers that you're working with. It's a good question about traders that use it extensively. Um, Off the top of my head, I can't think of anybody. The reason I say that that's a really good question is because there are popular names for popular indicators. Brian Shannon, for an example, uses the anchored VWAP a lot. Um, the guy from Simpler Trading, he uses the Bollinger Band a lot. You know what I mean? Like that's a good question. It's a fair question. I just don't know anybody that does it because, well, I never checked. So let's check. Let's just ask Grok if there's a popular trader who uses Z score. Hey, thanks for hanging out this week and hope you have a really good weekend. Get some rest. Yeah. I'm going to try to get the bike out, but it's like 78 degrees, so I don't know. I'm a fair weather rider. Probably not. Get it while you can. Yep. So I asked AI if it knew of anybody, um like the names that I John Bollinger, Wells Wilder, John Person, and no, there's nobody. But that doesn't mean that there's something wrong with it. It had one sentence that really stood out on this. The lack of a standout personality tied to the Z score in trading might reflect its role as a technical tool rather than a branded methodology. unlike indicators that are associated with figures like John Bollinger with Bollinger Bands or Wells Wilder with the RSI. So I like that as its answer. That there just there just isn't somebody that's doing it. It's not to mean that nobody is. I get it, guys. My entire family, including my wife, has no love for anything trading. And I will turn on like stock news, Bloomberg and things like that, and their eyes just roll. Like, oh my god, here we go with this stuff. So I did find the calculator. This is the right one. I will share it in the chat once I'm done explaining what it's doing and what areas to mess with, what areas not to mess with. Plus, I want to check it and make sure that it's still working the way it's supposed to. Sometimes during a stream, I break these because I'm playing with it, and then it gets saved broken, and I don't want to share it with you guys if it's broke. So, a credit calculator. I did mention the assumptions. Okay, so losses are always going to be 100%. We know that that's not true, but you should assume it's true before you take the trade because it'll help with your math. The delta percent is a chance of losing. If you don't understand what I'm talking about with that, on Wednesday, when we were looking at the options, we were talking about probability of profit or probability of being in the money, probability of being out of the money. And I had mentioned that old school, we used to just use delta. And if you had a delta of 12, then that option had a 12% chance of closing in the money. So that delta is your probability percentage. That's what the spreadsheet is talking about when it says your trade has a delta percent chance of losing. Working with IVR accelerates our P&L. I know that might sound a little complicated, but IVR is IV rank. When you work with IV rank, it can help you reach your profit goal faster, right? We just covered this with Apple today when we were talking about that reversal on Apple and how if you had put on a credit spread at the low of that move, it wouldn't matter if Apple ran all the way back up or if Apple just stopped falling. It fell so fast that the volatility exploded. And when it stopped falling, whether it rose up from there or not, the volatility would get crushed. That's using the IVR in your favor. That trade would accelerate its profits faster because it took vol crush and or had a price move that went with it to help you reach your profit quicker. Those are all assumptions we make with credit spreads. And the technical analysis increases our win rate. I had to write that down because there's so many videos that say you can trade credit spreads with no technical analysis whatsoever. And yeah, I mean, they're right. That's true. You can. But why would you? You know what I mean? Like, give yourself as much edge as you can. Bring technical analysis into the conversation. It doesn't mean you're going to get it right. And you may not know very much analysis, but anything you can add is better than nothing. The move off of the lows in Apple and at the money credit spread, the same one that we were talking about on Wednesday. My default go to at the money credit spread. Yeah, you'll find that a lot of my own thinking lines up with his. He was a big influence in my life when I was learning options. Now, I don't trade his style, right? But his philosophy, his concepts, I took a lot of those to heart when I was learning how to be a trader in the option space. Because I really like his down to earth approach to trading and just the lack of BS. He really just doesn't try to sell you anything. If you don't like it, take the other side. And I like that. So with this, what it's going to try to help you figure out is, am I getting enough credit for this particular trade to use the probabilities? If we're not, we need to find another trade, a trade that will either offer us more credit or have a higher probability. Now, we can make some adjustments to all of this. And as it says here, only write in the blue boxes, right? Otherwise, you can break things. You can put your delta in. When you go to fill this out, the delta that you want to put in is the short leg, because that's the one that is the pivot for the trade. Now, if you want to do it a different way, you can. You can use the middle of the delta. So if I sold the 235 and I bought the 240, then I've got a 13 and an 11. Oops, wait, that's theta. I got a 36 and a 22, right? What do I got? 235, 240. A 44 and a 29. We'll get there. You can use the midpoint of those two numbers. Here's the 35, here's the 40. So what is it? That would be like 36 as the mid. I could put 36 in for my delta. I wouldn't, but you could, right? Like you can do it either way. I like to use the short leg because it handicaps my trade, and I want to handicap it as much as possible in my analysis. So I would use 44 for that. In fact, we're just going to build this trade in that spreadsheet, right? I'm going to take a picture of this so I can see everything that I need. How much credit, what the strikes are, and I'll just set that to the side. That way I don't have to keep bringing this sheet back up again. Now, the total trades, one trade one time doesn't help us define whether or not this is a good trade. Let me bring this picture back for a moment. This is a $5 wide credit spread, and we're getting basically $1.90, which means we're risking $3.10. Is that acceptable, right? Like, one trade one time, no problem. But if I did 100 trades where I've collected $1.90 and risked 310, am I getting enough credit? Or at the end of those 100 trades, would I be in the negative afterwards? To answer that question, we use the spreadsheet. So you can use 100, you could use 1,000. It doesn't matter. The numbers just get bigger, but you need more than 10. So I like to use round numbers like 100 and 1,000 and 10,000, but use more than 10. The delta in this situation is a 44. The width of the trade is $5. The credit, I'm going to round up to $1.90. And it automatically showed us the debit correctly, so that's good. Our profit target, let's just use the norm. We'll go for 50%. And the loss target in this scenario, I was going to say it calculated it for us, but it doesn't look like it did. There's a drop down here. That shouldn't be there, by the way. Let's see what the notes say. Oh, it's from this over here. So we have to choose before the trade gets put on what our loss target would be. If we collected $1.90 and the trade starts to go against us, at what price would we exit the trade? We would exit the trade at $2.55, which would give us a loss of 190 minus 255. But basically, really, you're really losing the whole 255 because you got to give back the 190 and then you cover the rest, which is 65 cents. If you don't want to lose that much, then you would adjust it over here. Let's change the profit target and see if it updates these numbers, just because we got to check to make sure everything is running the way it's supposed to. It did not. Changes all the other numbers. All right, so that's really just helping you figure out where your stop should be. Some interest here. If this trade was done one time, not as a strategy, but just one time, you would win $92 if you're right, because that would be your half target, 50% profit, or 45 in this case. And one loss would be 312. Now, if we actually did it as a strategy and we were to trade this 100 times, the loss equals 13,752 and the win is basically 4,600. So is this enough credit? No, not enough credit at all. What would be enough credit? Let's bump that number up just to see when it finally swaps over to profitable. $2.75 or 225? Nope, that ain't enough. 275? Nope. $3? Yeah, no, we're still not there. It's 3.25. Basically, it's where it started to go in the right way. You can see where it starts to show up here. If you defended the trade or if you took it to its end. Of course, this has commissions built into it too. Give me a second. I got to figure out what the 15 here is. I think during one of my live streams, we changed this to Tom's style, where he tries to get 1/3 the width. If we change it to my style, when we choose the width of the trade, 50%, you should get $5 in credit. 50% of the max would be $2.50 of that credit, and 2x the credit would be the $10. Now notice how it just stays red all the time. No matter what we really seem to do, it stays red. It's because of this profit target thing. If we change that, the numbers change a lot. Now we're in a $10 trade with $5 credit. And because of our delta at 50, because we're at the money when we're doing it, we're going to win more often. And then with credit or with commissions, There's our profit. I've got another spreadsheet, guys. I don't want to share this one. This one's not doing the this is doing fancy stuff, and it's not going to give you what you're looking for. I need the other one. Let me see if I got the other one. No, that's futures. Futures, futures, futures. Yeah, that's like I haven't messed with it for so long. Like, nah, this isn't. I built one that was really simple. It was really clean, and all you had to do was put in your credit, and it just gave you your answer. Like, nope, that's not enough. And I'll show you what number to change so that you can always do the same strategy, and it'll be that delta number. I almost always run a 50, so I can just leave it at 50. If you're doing tens, you can just replace the 50 with a 10, and then you'll be good. Been a little while since I used Excel. I had to stop and think about it. So you put in the width of the trade. It's a $10 wide trade. I'll leave my delta at a 50. It's telling you, hey, collect $5 in credit. If you did that and you won, what would the outcome be? Take the total number of trades. I'm going to benchmark at 1,000. And just to see the handicap here, let's put in some bad numbers, right? Say we got a delta of 15 and We're going to use our own credit. So it's a way out of the money trade, $10 wide. Let's say we got $1.50 for it. If I collect $1.50 for a trade that's $10 wide, and I run that trade as a strategy 1,000 times, will this be a profitable trade strategy? Remember, a 15 delta says I'm going to win 85% of the time. So we already know what our win average is and our loss average because of this. The win average is going to be 85. And the loss average is going to be 15. Pretty easy, right? So far, so good. Let's change these two boxes for percentages, two decimals, so that it runs that way, right? See, it just moved the decimals over to the right two places. That way, it gives us a more normalized answer. So we're going to win 85% of the time. That sounds pretty good, right? Is that enough money to cover the 15% of the time that we would lose? Ah, that percent screwed it up. We don't want a percent answer here. We want just a regular answer. Let's see if we take that off now. See if it works. Sure looks good to me, right? If we win that, oh, no, no, no. We need to do the other side. I was going to say this looks good, but it's not. If we had a credit of that, what's our risk? There we go. So what this is showing us is if we run this trade with a 15 delta, our profit and our loss are the same. If we lose 15% of the time and we win 85% of the time, considering a full max profit or a full max loss, then these are completely the same. It looks like we would break even, but we know that's not true, right? Because we don't close these at max profit. A lot of times we end up closing them at 50% profit. So if we add in a profit target, 50%, We just need a 2 there, not a half, not 50. I don't want to do 50. Let's see if it's smart enough to do what I'm about to ask it. I don't know that it will. Whoa, yeah, 50,000. Nope, I didn't think so. It was worth a try. If we ran this at a 50% profit, then we really got 637. But when we lost, we were losing 1275. So this is showing, nope, it's not good enough. Something would have to change. Now, because you're closing early, you can increase your win rate, but we don't have a calculated way to define what your win rate is. And this is one of the reasons you want to journal, right? So I know I just did a lot of work there and it might have confused you guys. Focus on this. With this spreadsheet here, it was always showing loss, nearly no matter what we did, right? It was showing loss. Like no matter what the strategy was and no matter how much we collected, it was still saying that we were losing. Why? Because we were closing it early, but it's not giving us our increased win rate by closing it early. This still assumes we're going to lose 50% of the time. And we know that that's not true. Closing it early would increase our win rate. So if we adjusted this delta just to see the outcome, not because we're going to choose a different strike, but let's just assume we get a 15% bonus to our win rate by closing early. If we did that, then we're going to win 65% of the time. And I think in the original one that I ran, that it had an assumption of a 75% win rate on a 50 delta. I think that was the number that I used, and that came out of my own stats. When you journal your trades, say you run credit spreads all the time, and you journal your trades and you realize that you're running at about 75% win rate when you're doing a 50 credit spread at the money. That's about what my stats are. 72 some months, you know what I mean? 69 one month, it wasn't that hot, but 80s on another month. I rarely fall below 65% on the credit spread win rate. And that's pretty good. And that's not having to make adjustments. When I make adjustments, I can get my win rate higher, but that doesn't help for this. So I'm opening it at the money with a 50-50 chance of winning, but I'm actually winning about, let's just average it and say 70% of the time. Well, that changes all the numbers. That way, even though I'm only getting half the width of the spread, because I'm winning 70 to 75% of the time, all the numbers work out. Now, with this profit target, I'm not closing them at 75%. A lot of times I'm hitting 35, 40% profit. So you want to build the spreadsheet in a way that reflects your actual trade style, but keep track of your trade records to see, hey, what's my average win rate? Because I'm closing early. This, remember, is always designed to calculate 100% loss if you lose. But closing early increases our win rate better than whatever the delta actually is. I just set this at a I had it inverse, right? When I went to 75, it was like going out of the money and going this way. This would reflect the 75% win rate right there, 25. And you can see that it's greens across the board that we would win. It's half the width of the spread. And with a 75% win rate, we would win more money than we lost, even with a max loss on those trades. So I'm going to spend time over the weekend. I'm going to put together a real simple one. But when it comes to that handicap of your actual win rate, you have to make sure that you are closing early to win more often than the delta says you should win. And if you combine that with never taking a max loss, you will be in the green. But if you don't combine those two things, then you're screwed. And if you guys want this one, I'm more than willing to share it with you. It's got notes on the back end here on what to do, what not to do, some of the things that they say on YouTube that are funny. It talks about some other styles of options trading. This is my list that I learned from when I was new to trading options. All of these are options trades: index arbitrage, mean reversion, delta trading, box trading, dispersion trading, and gamma trading. Right. So um, I don't like this spreadsheet because I've done too many live streams with it. Obviously, I broke something along the way, but the formulas are in there. You're more than willing to use it. Just this isn't the one that I wanted to share. So we'll leave it at that, and I will post it in the chat. The Apple midpoint. Not quite sure what you mean. Oh, when it comes to what your delta is, I always use the short leg. So if I'm building a credit spread here, we don't want it three legs. We only want two. If I sold that one and I bought this one, I would use the short leg because that's how I was always taught to use it. The short leg is 17 and the long leg is 9. Well, using the short legs, what I always do, but there are people who will use the midpoint between the short and the long, and they'll average their delta and say, well, the delta of this trade is the midpoint between those two. So you can go that route. Now, there's another way to go too, and that is I can right click on this trade, send it over to the analyzer, and the analyzer will tell us the actual delta of the trade itself, not the strikes that we picked. And that's what they're trying to do when they normalize it, right? So trying to get the mid isn't actually getting the delta though. Here's the delta of the trade. If we actually wanted to get, the real delta of the trade, and we could use that in the spreadsheet. I don't, but we, what I mean, we could. So for me, guys, anything, anything can be run in a credit spread. And my hang up with the strategy, the way that it was taught, is that we have to find high IV stuff, and then we want to go out of the money to like a 10 or a 15 delta and put on credit spreads. And I hate all of that. So I decided there needs to be a way where we can run the strategy, and no matter what the implied volatility is at the time, it won't hurt us or handicap us or keep us out of the trade and say that we can't use a credit spread. Right. That's what everybody's taught. I don't like it. And the reason I don't like it is there's no way to define where you should close the losing trade. And no matter what you choose, you're handicapping your trade and you're breaking it too. So for an example, if I put on a credit spread, a call credit spread, when we were against this high, let's zoom in here a little bit. No, in fact, let's say I put the credit spread on when we were down here, but I used options that were up here, 235 and 240. So I've got a 235, 240 call credit spread, and I put it on when price was down here. This is my short leg. And this is my long leg. My entry was down here towards the later part of the day. And we'll say that I collected in this $5 trade, I collected 75 cents just because of how far let's make it a little better, a little bit better. I got $1.25 for this trade. Why not, right? Splurge a little bit. So I got a credit spread of $1.25 in a $5 wide trade, and it's out of the money, and there's the levels. Now we can do the break even on that. It's like 236.25. That's the break even. As long as price doesn't close above that, we're good. But let's just leave it at this and say if we close above 235, we're going to lose. Now, since I've gotten in it, price has come against me and I'm in a losing trade. But it's only going to be a loser if we're above this red line at expiration. And it's not expiration. In fact, we're going to say we got it for the October 31st expiration or at the end of the month, whatever that the end of the month options expiration is. We're nowhere near that. We're not even above the line. Should I close this trade as a loser? And by the way, since I've been in it, I'm down 75% of the trade at this point, right? There's barely anything left. Why? Because it's been going against me since the day I got in. If we open these trades the way that they tell us to do, like this, and it starts to go against us, we're wrong almost immediately, and the trade starts to bleed badly right off the bat. I mean, it's just losing at this point. And if you had closed it anywhere along the way, you would be locking in a loss. But you don't know that it's a loss yet because price could come back down. It could reject that high, fall away. You don't know. So you do what we all do. You hang on and you say, no, it's still got another month at least. All right. Actually, it's got 2 months because next month is September. Then we're into October. We've got plenty of time. No reason to close this. If you don't close it, your loss is going to be nearly 100% by the time you uh, get above the line and you realize how bad it is. And if it's almost at 100% loss, you're going to say, well, screw it. I might as well just leave it on now. It's already damn near 100% loss. Why close it? So you'll leave it on and it will go to zero and you'll take a max loss. If you closed it early, you're just locking in a loss, even though you're never quite sure that you should have closed it early, right? It's a lose lose all the way around, which is why I don't like this scenario. If instead you had put it on at the money when it was down here and it started to go against you, the break even was at the money. So you already knew, hey, this is going against me. It's starting to lose. Already, I can tell that. It's beyond my break even. My loss is minimal at this point. I get my hand slapped to close the trade and move on, go to something else. My style doesn't matter what the IV is. This says we shouldn't have put a credit spread on anyways because the IV was really low. We don't want to put a low IV credit spread on. That's bad. You're not going to get very much credit when you do that. Plus, if you put it on when the IV is low and then the IV goes against you, it increases the cost of that options trade. And that's not what you want because you sold to open. You want it to decay. So now you're fighting price and you're fighting volatility. So they say don't put on a credit spread when the IV is low. That keeps you out of some really good trades. So I don't like that rule either. The way I do it, it doesn't matter what the volatility is. It could be high, it could be low. As long as it's not extreme, you're good. And I don't like to trade things that have an extreme IV anyways. So I don't have to worry about, oh, the IV's low. I guess I can't do a credit spread. Nope, I can do it anyways. Put it on at the money. Try to get half the width of the trade in credit or near that. Doesn't have to be spot on perfect. And if the trade goes against you, you close it, you take a small loss, and you move on. And there's no hand wringing about, oh gosh, I'm down already and it's this big loss. And nope. Plus, you get a lot of credit when you open at the money. You get half the width. So you have a higher win rate, way more profit. You don't have the handicap of the implied volatility going against you. And you're never stuck in that loop where you're like, well, I don't know. Should I close this? Should I hang on to it? Is there any way that I can, figure out how to do this better? Because there is no better way. You'll never know if you should close those early or not. They're always a horrible situation. So I like my approach. It doesn't have to be completely at the money like this one. This is literally right at the money. You can go one out of the money, just slightly out of the money. And you're still getting a lot of credit. You still have a really high win rate. And when these don't work, you can often roll them, adjust them, modify them because they're still relevant. And they got a lot of liquidity because they are at the money. They're not some way out of the money penny stock trash or penny price trash, not penny stock. So when you combine that with support or resistance levels, then things get even better, right? And of course, we can define support and resistance any way we want, but it can be anything. Uh, Quadrant lines and levels, trend lines, Bollinger Bands, Keltner bars, whatever we want to use. Let's see what the drones list offers us. We can maybe use one of those for our examples. Nah, we got that trend line rejection, but that's it. We haven't run back up to reject it again. I think ARC has some liquidity. Let's see if we can find a 225, 228, 25, 28. Yeah, we're just pricing things. Oh yeah, no, look, that's trash bag holders. So we wouldn't even try it. We'd want to scrunch that up and use something like a 26, 27 at the most. That 28's trash. So skip that. Half the width in credit at the money. We don't really have a reason to put this on, right? But it just shows the example. It's not on support or resistance right in the middle of nowhere. This is not a trade we would want to use. If I did want to argue for it, I would take the put side instead because it's at half the big candle width. Right? It's on the half. But I don't want this trade, right? This isn't a good trade. Just pointing out an example. So let's see what else we got. All right, TDY on support 535. So we could look at that and do a 540, 530 credit spread. Now we can see we're handicapped here. There's something wrong. I know to stop right there and not even put the trade on. I'm at the money, one in, one out. I should get half the width in credit, or at least close to it. 480, 485, something like that. Not $4 in a $10 spread. Nope. So we already know, hey, something's wrong here. We don't want it. Plus, look at the bid ask spread. That's what's wrong. Look how wide this is. This is trash. No liquidity, really wide. It's trash. We already know because of the price. We just move on. Like, nope, I don't want that. That's junk. Doing it my way reflects all of the pieces that you need and deals with all of the issues that we might end up dealing with. These don't have monthlies. We don't even need to look at them. JOBY. Yeah, it's got a little bit of liquidity. Not much. Wow, $18. Those 18 strike calls are getting some love today. No puts traded, except in some in the money puts. We'll find something. Sure, why not? Let's use NVIDIA. We know it's liquid. And it's on that critical level 272 or 172. So that gives us 170, 175. 215, it should have been 2.5. They're a little light on the credit. We're closer to the 175. So they should have given us more than that. We can try to, ooh, that's the wrong way. Try to adjust, bring it in a little since we are almost at that. That's not enough. But at least we know that, right? We know it when you build it, you're not getting enough credit, just move on, right? Like don't even need to haggle with it at that point. Archer, it's got liquidity, $1 wide strikes, bid ask spread looks good. I think we found a contender. That's nice, and it's on support. There you go. Let's use this one. Okay, they're a little light. 44 was a little light. 46 is okay. Try to work the order for like 47, 48 if you can get it, but we're in acceptable range there. If we was to put this trade on, the break even would be 853. And what I recommend people do is put lipstick on a pig. Write out on the chart what your trade needs. especially if you're going to have a lot of trades on. You get 130, 150 credit spreads going that extend over a few months. And if you don't have the notes to keep track of everything that you're doing, then every one of your charts, you got to sit there and try to figure out, okay, now what was this trade? What do I need? What's my break even? Annotate the chart, get it all drawn out. Then you know exactly what you need, what your trade is. I screwed that one up. There we go. Short put vertical. So you're going to overlap things, right? But get all your annotations on there. Your drawings needs to stay above. You can use your boxes to where, color code all that green and then all of this as red. That way you can just see at a glance, is the trade still winning? So that you can just jump through your charts and look and see, is this one winning? Is this one winning? What does this one need to do? See, to me, that's pretty easy to read. I can be jumping through my trade charts, get to this, and be like, oh, it's still good. It's above the vertical, above the line. Except I can't seem to click the one that I want. Get out of the way. Let's just get that one out of there. Price isn't working right. So annotate your drawings. It helps visualize what your trade needs. If we was to put that on, the size of these boxes don't matter, right? Like it's just anything below that is red and anything above that is green. How far up it goes doesn't matter. How far down it goes doesn't matter. It's that line in the sand that matters. And then have some rules in place for what you will and will not trade. I have people ask all the time, what's a good trade list? Or what kind of stocks should I be looking to trade with this particular strategy? Short verticals, long verticals. So if you put your rules in place, you already can define what is tradable. For me, the rules are things like, does it have dividend? Does it have earnings? How wide is the spreads? No earnings, no dividends, no parabolic moves, no big, massive, unexplained, needs that word, unexplained, no unexplained gaps. Companies, no companies that are less than $10. That can be adjusted depending on what you're working with. Ford, for an example, is a good company, and it's oftentimes it's below $10. So, there's like an airline company too that's below $10. So that's negotiable. But what you consider quote support, it could be a trend line, a fib line, a previous price pivot, a moving average. It could be a breakout trade. Well, then you have to define what's it breaking out of. Maybe it's breaking above the fib line or breaking above a price pivot, or breaking through a moving average or an angular trend line. If it's gapped, gaps always offer really good possibilities. Red day yesterday and it found support. Red day yesterday and it closed near the low. IX10 gapped above the previous day's open, or even better, above the previous day's high. And then what if? What if can save you from taking the trade? Look at the next lower support and ask, are you willing to stay in the trade for an additional plus 60 days or more? Because that's what's going to happen if we fall to the next lower support. Are you willing to be in there that long? Are you willing to hold it to that level? And it could be this used one direction, an upward trade talking about support. But what if you went short? Then look up what's the next higher resistance level? Are you willing to stay in it to that point? And then look again. Elevated volatility, alternate products. If the thing you're trading has bad options and you still like the trade, look at one of its peers. I'll bring airlines back into it for that one, or EVs. There's only like two airlines that have decent options. If you want to trade airlines and the one that you want to trade has bad options, look at one of the other airlines. Maybe trade that one instead. With the days to option to expiration, consider what you're trading. Is it a counter trend or a short duration trade? Then use the following Friday or 11 DTE. If it's markets that are already in a confirmed uptrend, then you can use 30 to 45 DTE. If it's a market with a uptrend under pressure, you could use 65 to 90 days. These are just my rules, right? This is what I put together for my trading style. And this is what I call a public credit spread. That at the money credit spread, I named it public credit spread long ago. The option strike, collect near 50% of the width of the trade. If you're opening with a one lot, keep the trade $1 wide strikes or $3 wide in the strikes or less. If you're opening up a two lot, keep the $100 50 and less, and a three lot, keep it $1 wide or less. And then some liquidity rules and taking profit 25% if I'm just fading out of a lot of contracts, 50% if I still see that there's risk, and I'll go to 80% if I perceive that the risk is low. And then there was an example of a trade, and in the SPX, it's a $10 wide trade, $4 in credit. In the SPX, that's pretty much the norm. You will not get half the width of the spread in the SPX. You just won't. And if you do, don't take it because they never give it to you. So if you actually find it, they're trying to bribe you into taking it. You don't want it. So when you put your own rules together like that, right, and you lay them out and they are in stone to where you can keep track of them, then you can just go through and check your rules. Does it have A, B, C, D? Yes, then I'm good. It can remind you to check things like dividend and earnings, and maybe that's the spreadsheet I've been looking for. I don't think it is because it's mechanical, but let's check. I think maybe not. I think this is a my 2020 trade log. Yeah, that's the trade log. So you guys know in 2020 I went live with mechanical trade strategies for single call spies, iron condors, and butterflies. I don't see the butterfly down here, but I ran the trade for the whole year. And that was the year of COVID, if you didn't catch that. But I didn't know it was going to be a COVID year, right? In 2019, I put all the rules together, and January 1, 2020, I'm ready to go live, right? Like that was the plan. Like, yay, it's January, went live, and then COVID hit. Now these rules are mechanical. You're not supposed to have any bias, like, oh, I'm not feeling it, it's FOMC week or whatever. Nope, you just follow the rules. The rule says buy today, you buy today, or sell today, you sell today. So even though COVID hit, I ran it anyways, right? Whatever, I'm going to run it. I believe this is the straight up calls, right? Like me buying a call. You know what the rule was for this is that it was Tuesday. That was the rule. How arbitrary is that, right? Like every Tuesday before noon, I'm going to buy a call and SPY. That was the rule. It has to be an at the money call with 12 plus days to expiration. Stay below $5 per trade and close it before 75% profit. Close the losers at 2/3 loss or if it got within 3 days to expiration. Now, I had to adjust that rule during COVID because all of SPY's options got so expensive, I couldn't find a call that was $5 or less. The calls during COVID was like $9, $15. So like, well, shoot, that ain't gonna work. I had to put them into a spread instead of just buying a single call. I was buying called debit spreads, and I noted that on the 17th. You know, what I mean, there's just nothing I can do. Pricing for the calls has grown too large. I have to swap to spreads. So now the new rule was keep the spreads below $5. Go two strikes in the money at the most, one strike in the money, one strike out of the money. Collect 1/3 the width of the spread at least, which would be spend 1/3 because these were long. So just a typo. I should have wrote spend 1/3 or a little higher. On March 1st, I had an issue because of liquidity. I can't get good pricing on the spreads, and the trades were paused. Things got really bad in March of COVID, and there was no liquidity out there, guys. None. New rules: stay within 2/3 risk reward on the spreads. On the 19th of March, I didn't get a trade that day. I wasn't home to do it. Things in my life were going on. I couldn't get a trade that day. Same thing on the 16th. Nothing happened. Um, After a few losses and evaluation of market conditions, I changed the target profit to close before 50%. So locking in lost profits earlier. Remember, closing early increases your win rate. The strong rally in the market has not faded, but the options are still very costly. We'll use credit to finance call costs at the money. What I was doing there was I was like selling puts to help pay for these because the options were just so crazy expensive. So by July, prices were starting to come down, thinking about removing the spreads, just using calls again, increasing the target to 75% of the max because the price of the market is accelerating too far away to consider spreads at risk. After two losses in a row, I was thinking about putting it on hold. I didn't have to though. And then I did end it on the 3rd. By October, calls were back within the rules, so started running them again. Went back to 50% profit. All of this was mechanical, right? All I had to do is just keep track of the rules and look at what the market was doing and evaluate my wins as I went by, right? You can see win, win, win. losses, wins, losses, loss, loss, win. Then it swapped to spreads, wins. So to sum it up, by the end of the year, running that strategy with just calls on Tuesday because it was Tuesday, by the end of the year, that was the outcome. Now you got to move the zeros over, right, to account for, we don't actually get $1.10. It's really 110, right? So it wasn't bad, all things considered, but I had to adjust things along the way because COVID, you know, when you go to put yours on, who knows? It could be, well, I had this strategy and then this guy got elected and kind of broke the market and I had to change the rules. And mechanical trades are great because it will help you with the idea of staying consistent in your trades and then having the rules in place to define what you're supposed to do, when you're supposed to do it, how you're supposed to do it. If you run your credit spreads the way that I'm talking about, near the money, at the money, if you run them that way for 10 trades and you're being fair about it, meaning you're not getting into like some really nasty stuff just trying to prove a point. I think you'll really change what you like about options and probably grow to adopt my style rather than the industry's style. Their whole hang up is, hey, you can trade these out of the money options and win 80% of the time. Yeah, so when you lose, you're going to lose all the profit plus some, guaranteed. In fact, anybody who gets that strategy to work, Tom Sosnoff brings them onto his program and asks them, "What did you do?" Like it's so rare that somebody actually got it to work that Tom's like, "Hey, you got to come on my show and what'd you do?" And they found some cheaters from that along the way, right? This lady that was running this really big service for clients, and she was charging them quite a bit of money, and she was known for having really grown this massive amount of capital. And they had her on twice doing interviews, and then found out that she was cheating her own rules, breaking the system, and blew it up. It's rare to find someone that can get it to work. Now, I'm not saying that you should never do an out of the money credit spread. That's not it. That's not my argument. There are times where it's okay, you know, to suit the needs of a particular situation. Why not? Go out of the money, put on an out of the money credit spread. But if it's just for a strategy, I would not use the 15 or 10 delta strategy. No way. Now, the adjustments kind of have to fit what you're working with, right? Like in the spreadsheet, I was talking about adjustments there because of COVID, but uh, run it another way. Say, let's use the gas station analogy for a minute. Every day you go by the gas station on your way to work and gas is $3, $3, $3, $3, $3. And one day you go by the gas station and it's $1.75. Now, even if you don't need gas, you're probably going to pull in and get gas, right? Because I mean, hell, it's $1.75. You'll get it just for GP. But if you go by every day and it's $3, $3, $3, $3, and one day you go by and you really need gas and it's $5, you're like, hell no, I'm not paying $5. It's almost always $3. Every time I drive by here, it's $3. I'm not paying $5. You'll go to another gas station. Even though you really need gas, you'll risk it. Go to somewhere else. So you have a feel for what that normal gas price is. Bring that back into the options trade. If you're doing a consistent trade style especially if it's on the same product like the Spies or Q, and you're doing it all the time, and you got a feel for what normal looks like, it will stand out when you get something that isn't normal. And that can tell you to just stop right there. Like, well, I was gonna run my strategy today, but I just seen that price, and now no way, I'm not doing it. And if you keep looking around and that new crazy price is the only one you can find, you might have to adjust your rules, right? Why? Because you can't find normal price. And when things break in the market, it usually lasts for more than one day, which is why during COVID, it changed everything. And I would let it run like, well, I'm going to try this. And then I'd let it run for a while. Like, nope, that's not going to work. I'm going to have to try this and make another adjustment. You have to. Yeah, yeah. Now, what's his new goal, right? What's the new target? I'm still really curious to hear him try to define where neutral is. How do we know that we're in restrictive territory or above the neutral rate if you can't tell me what the neutral rate is? Yes, sir. Somewhere in there. So when it comes to the strategy, you want to just start with the broad outline, run it a while, and make small adjustments. Don't change a lot of things all at once because then you're going to get a completely different outcome and you're not going to quite know for sure which one of those things you changed gave you this new outcome. So make one small change at a time and then run it again for a while. We were talking the other day about how many trades are on, and it boggles the mind that you could have, over 100 trades and not be overwhelmed. But if the trade has already progressed to the point where it cannot lose, I don't even pay attention to it anymore, right? Like, no matter what happens, it's a profitable trade. I throw it in the corner. Maybe I set an alert on the date of the thing so that I don't forget to go in and check to make sure it's still, you know, n- out of the money and everything's fine. Otherwise, I don't even bother looking at it anymore. So if you have a trade on and it needs to be adjusted, if that's what you're talking about, fixing a trade that isn't working, yeah, now I got a client that I was making a video for, and I can share it in the chat with you guys. But this is the same thing as that gas station analogy. When you go to roll the trade, say it ain't working or it is working, you need to know that the roll is good. Well, how do you know that it's good? Unless you've been looking at it every day. I've got positions on and I go through and cycle through those trades. Now, I don't cycle through every one of them. That would take forever. Plus, a lot of the ones that I'm holding, they're already risk free and I can't lose. I'm talking about the ones that are not yet risk free. When I go cycling through those, I try to roll them, not because they need rolled, but because I want to know, hey, what are you offering for this trade in a roll today? When I look at it tomorrow, I can compare that to what I got today, and I can compare today to what I was offered yesterday. Every day I try to roll it just to see, hey, what do you give me if I try to roll this trade? What are you offering? If you do that every day, every day, every day, when you get a better offer than what you have been getting, it'll stand out. And if it gets worse, it'll stand out. But if you don't do it at all, the one time you need to go roll it, then you're going to be stuck with that question of, is this a good roll? I don't know if it's a good roll or not. Well, how would you know? You haven't been looking. And as for the question of, but when should I roll? You'll know the roll when the price is there, right? Like that's when I know to roll. There's nothing in the Greeks, there's nothing in the chart that's going to tell you that this is the right time to roll. It's going to be, can I roll this? Right. Roll it or to make it into something else. I was looking for a trade to see if I had one that could have fit. We did Apple not too long ago. We fixed this, not fixed it. It was already good. Um, we just rolled it because it was already good. Now it's not so good, but it's not necessarily losing either. You have to know what the normal is to know if what they're offering you now is better, right? So you want to try to roll it all the time. But if a trade isn't working, start with, what can I do to fix it? The way that they talk about it on Tasty Trade, Tom says, I don't bother with the one that's losing. It's already losing. Just leave it alone. What he likes to do is go to the other side of the street. So if he's in a short credit spread on the call side, he'll go to the put side and put on a credit spread over there, or a debit spread. You know what I mean? Like he'll add to the trade, but on the other side. And that way, he's not even messing with the trade that's losing. He's just adding more trades to the position. You got to kind of take that with a grain of salt, because if you add to the trade in any way, you're adding to the risk. There's no other way to say that. You're bringing in more risk, because now you got two trades on and both of them could lose. Right? I mean, to be fair, that's the market. That's how it works in the market. You can take both losses. And sometimes it's better just to not, right? Just to leave it alone. Anything can be rolled if you're willing to put enough risk into it. And then a lot of times it's not worth it. You're better off just taking the loss and moving on. I say that, but I see people put on those 10 delta trades where they've got $1,000 at risk to make $200, and then it goes against them and they're like, dang, I'm getting my butt kicked. This trade's going to lose $1,000. What do I do to fix it? And then when I add another $1,000 of risk to try to fix the problem, it's like, don't do that. Please don't do that. You're just making it worse. But the outcome to that one would not be, oh well, just eat the loss and move on, because that's a lot of loss. And try to define it from the other side of the position. And know your broker. When you go to roll, what are they showing you? We talked about this last week, but when you go to roll the trade, some brokers are going to show you what your new position is worth, like Thinkorswim. And other brokers are going to show you what they're about to do to the position that you're currently holding. So if we, both of those are calendars, so I can't use that. Yeah, I'll just use Pepsi. So if we take Pepsi here, if I was to roll this, I know the market's closed now, but if I was to roll this up, it says $57 in credit. My new position would not be a long call with $57 in credit. What my new position would be is a long call for $32 debit. They are taking $57 off of the cost of that call. So I'd be holding a long call for $32. That's the way that Tasty does it. It's telling you, I'm going to do this to the current trade that you're holding, and this would be your new position. So at least I know, right? But what if you're on Fidelity or IBKR or some other Webull, Robinhood? I don't know what they do. You'll have to do the roll and actually hit submit and then find out, okay, which one of those two was the answer. And then remember that so that you don't forget. I know that there's a lot of stuff out there on the internet that makes it sound like if you could read the Greeks really well, that you could come into the options chain and that the information here would tell you to go long the market or short the market and what strikes to use to do that and what expiration to use to do that. But it's not exactly true, right? I know that that's what they make it seem like out there, but in reality, that ain't the way it works. There are times where that's possible, right? There are times where that is possible, but most of the time that's not true. Instead, you're going to want to already have a directional implication based on the candle chart, and then you go into the options chain and you see if it can match what you already found. Because I can identify support and resistance in the candles, and then I can go into the options chain and I can validate that support and resistance in the options. That's totally acceptable because you're putting the two pieces together, and then you've got support on the candles, which you identified also in the options. You got a better idea of where your restrictions are at. Some notes that I'll add to all of this: in short term trades, I don't like to get into a trade after it's already been moving in the direction that I want to go. If it's a longer term trade, I don't mind as much, right? Like, say, SPY. If I was wanting to go short here, I wouldn't mind that we already had a down day. No big deal if I was taking a swing trade. And I mean like 6 to 8 weeks swing trade. But if I was looking at this and thinking, oh, yeah, by Tuesday or Wednesday, maybe Thursday next week, I'll be out and take a short, I wouldn't have done it because we're already red. I would have done it during these 3 days when we were still green. So when you ask about options trading, there's a couple of ways to answer that. On the bullish bears, we have the introduction to options. I didn't make that. Then we have the next level library. That I did make, but there's a gap between what the intro offers and what I put on there. Then we have an advanced class on the bullish bears, a whole class from like A to Z of advanced options education. And that's really good if you go through my beginner intro that's on YouTube, which is still under the Bullish Bears logo. But I did a beginner's class. It's like 10 weeks, 12 weeks. I did do one. And I would recommend that you do my beginner first before you do my class second. Because if you don't, my class as the advanced level, it's going to be too much. I'm not seeing it now, but I shared the playlist for that last week or earlier this week. It can't be that far back, right? That ain't what we need. That's what I was thinking. There it is. Introduction to options. I had one for a while, and then when I sent my computer to the shop, I cleaned house and took everything off my desktop to do that. I've got a guy that resets my system, wipes everything out, opens it up, disassembles the computer, blows it out, cleans it out, puts everything back together. Every time I send it to him, which is like every other year, you know, I lose all the, I not lose, I consolidate all of those files into one big junk drawer, and then I start all over again. So then I end up having to go crawling through the junk drawer to find it, which defeats the purpose. And so go through this intro to options first, and then go through the options class on the next level library, my options class on the next level library. And even though it's intro, I had a lot of people say that they had been trading options for more than 5 years, and the stuff that I was covering in there had they have never even come across after having traded for years. Because I keep thinking it would be great to go back and really expand on our introduction to options on the website. The problem is it's not my website, right? I have to write what I want to write, give it to somebody, and then they got to put it onto the website. And I don't get a say in how it looks or what the title is because they want to match it to some Google SCR ranking, and they want to use keywords, and I end up with titles that don't match what I was trying to say. And I don't get to say where it shows up in the menu tree. It's a big mess. So yeah, the options stuff under options trading, these are all my, well, I you might find a video from Creed or Jeremy or maybe Dan or Lucian, but most of this stuff I made. And what you're looking for is advanced options strategies. That's my advanced class that I went through, which was live streams here in the Discord. We just, we'd show up on Wednesday afternoons and we'd spend 2 hours going through a book that I had wrote and just working our, wait, I don't think this one had a book. I think that was the intro stuff, but we would work through the topic of the day and ran through all of these. And then the school will really help if you've gone through the IV school, which is like 20 videos. For the other stuff that's on here, I thought I did a really good job of laying out each piece of each kind of trade. The number one complaint that I got from people who watched these videos is that I covered everything in the video. But I was new to doing videos back then, and it didn't cross my mind to make 10 videos on debit spreads, right? Something that's 15 or 20 minutes long that talks about one part of a debit spread, and then make another video 10 or 20 minutes long that talks about another part of the debit spread. I didn't think about that. I just made one video like an hour long that covered every damn thing you could talk about. And people were like, it's just way too much for one video. Oh gosh, like trying to eat the whole cake. I know, right? Like it's a bad habit, but yeah, I can't help myself. I don't want 5 videos, I want one. But I'm the guy that would sit down and binge read a whole book in one day, or watch all of The Walking Dead in a weekend because I just can't help myself. Yeah. Oh. So we went through the Z score today, and it yet again highlights standard deviation. So I can't stress it enough, guys. I know math is not a lot of people's, bread and butter. They don't like it. They think they're no good at it. But I'll encourage you with this. Most people that I know who say they're no good at math never learned how to do it. They were in school and things were fine when it was simple math, addition, subtraction, multiplication, maybe a little division. And then once they started getting beyond division, their scores started to drop, but they were still passing scores, mid 80s, high 70s. But then when they got through, say, light algebra, they were basically over their head at that point. And by then, they had already failed what they were supposed to have learned, but they were getting passing grades. So they just kept going to the next thing and the next thing and the next thing. Just because you had a passing score didn't mean you understood what the hell you were doing or that you were proficient at it. You just had it well enough that they could go on to the next subject. And so people end up crashing and burning by the time they get into statistics and algebra, and they just fail. And they think, well, I'm stupid. I suck at math. I can't do it. And that's not true. You just didn't learn. So if you go back, and there's so many places you can do it for free, you can just go to YouTube and search for math class. You can learn it for free, right? Yep. That's true. Yeah. The better you understand math, the better trader you will be because you'll understand the risk better. It will define so many things for you. You'll grasp indicator logic easier. You will grasp so many things easier because you'll understand the math behind it. Nobody says you have to do the math, right? Like I don't calculate my own standard deviations. I could, but I'd probably have to get my notes out to do it. But I understand it, and that's what matters, right? Even if I don't necessarily want to have to actually do it, I understand it. We're talking about simple things like how to calculate, the mean, where how to find the average, what the right side tail risk is. These concepts might sound complex or complicated, but they're really not. So if you can get onto the other side of it, you will be a better trader and you'll understand what's going on around you in a more fundamental way. And it doesn't cost you anything but time, right? The Khan Academy is exactly what I was thinking of. That guy is awesome and it's free. I know that there was stories written of school districts that picked up his class and was using it to teach kids in school. How awesome is that? Yeah, I tried to help my niece with stuff a while back, and she's like, "What are you talking about?" I'm like, "Well, you show me what you do." And I have no idea what the hell she did. She did something, and I'm like, "Yeah, okay, okay, you don't ask me. You better go back and ask your teacher," because we were both getting the same answer, but we were getting it from completely different directions. And I have no idea what they are teaching in school nowadays. Way I don't know, maybe that's why it was more complicated, I don't know, but I have no idea what the heck she was doing. Yeah, it's crazy different. But the outcome is the important thing, right? Because her and I were both getting the same answer, we were just getting it from really different directions. Yeah, on that note too, I know I say it often, and I don't say it I don't mean it to be anything other than what I'm saying. I spent months learning moving averages. Months. And I'm not a stupid person. I had somebody quip back at me one day, "Really? Months? I learned it in a day." Okay, great for you. You stopped after day 1, right? I spent months learning about moving averages because there's that much you can learn about them. There's so many things that you can learn about something as simple as a moving average. And at the end of that, I am really proficient with moving averages. I did the same thing with Bollinger Bands and VWAPs and RSI and stochastics. I spent months on them. I'm not a stupid person. Why did it take months? Because I kept digging. What else could I learn? How else was it used? How else is it calculated? What adjustments have others done with it? Why was it built in the first place? For what kind of market? What happened to it over the years? Are there any popular adjustments that I can make with it? I dug as far as I could dig. The more you understand about what's going on, the better it works. And what I see a lot is people that say, "Show me what it looks like. Show me the setup. Give me the visual representation of what you're trying to do." Oh, okay. So when price gets to that point, I go short. Oh, so when the indicator goes to that point, I go long, and that's it, right? Like we're just monkeys pushing the button. That's how they sent that one into space, or the dog, whatever it was, the Russian dog, the US monkey. I mean, if that works, great, do that. Me, I want to know as much about what I'm doing as possible. I want to understand as much as I can understand about why price is doing what it's doing so I have a better idea of what it's supposed to do next. You look at what it's not even 80 degrees out. We're not getting the bike out today. Uh-uh. It's cold out. All right, we'll do it. All right. We're gonna get the bike out. We're gonna go freeze our cookies off. Everybody, have a good weekend, long weekend. All right. Enjoy it. Get some R&R. Step back away from all of it. And when we come back, it'll be a new month. We'll be 3 days away from major news that should rock this market. And on Wednesday, I think we might evaluate what some hedges can look like and some lottos because I think both are applicable in this environment. I'll see y'all next week. Later.